The market is volatile, and many investors are unsure whether it's the right time to buy. Most people are waiting for some perfect moment to make their move, while others are simply too afraid of losses. But by doing so, they miss out on one of the best opportunities in investing: buying undervalued dividend stocks during a market dip. In today's video, I'll show you and John 5 dividend stocks that are currently at 52-week record lows. That'll help you earn more passive income, setting you up for long-term wealth. I'll show you why they're so underpriced, and in the end, I'll show you a 52-week low stock that can turn your $10,000 to more than $1.4 million. First things first, a 52-week low stock is a stock that's trading at its lowest price over the last 365 days. This metric is a key indicator for investors, signaling potential undervaluation or opportunities in the market. But why do stocks hit these lows in the first place? Well, it's not always because the company's in trouble. Sometimes it's just the market acting up. The entire market might have a bad day, or maybe even a bad month, and some solid companies get caught up in the mess. Other times, it's company-specific. Maybe a business missed its targeted quarterly earnings by a hair, or a CEO decided to retire. Even things like macroeconomic trends like inflation or interest rates can push stocks lower even when their long-term potential is as strong as ever. But while the market panics, you can spot these opportunities to buy low and hold on for the rebound. And for dividend stocks, it gets even better. When stock prices drop, dividend yields go up. That means you're locking in a higher payout for every dollar you invest. Some of these stocks even come with solid perks like strong cash flow or a solid dividend growth track record. Coming up are 5 dividend stocks that have hit their 52-week lows, ranked in order from good to absolute best, based on their projected future growth in share prices, dividends, and yields. Let's kick things off with Smith Corp, with the ticker AOS. This company's one of the leading names in water heating and treatment. It's been a steady performer in the stock market, offering solid dividend growth while maintaining strong fundamentals. With a forward dividend yield of 1.88% and an impressive 15.79% dividend growth rate, this stock has long-term potential written all over it. The stock recently dropped due to slowing consumer demand and rising material costs, especially in North America and China. Supply chain disruptions also contributed to weaker margins. Despite these issues, the company's expansion into energy-efficient products and global markets positions it for future growth. As economies recover and demand for water products rises, Smith is expected to rebound. So let's see how this plays out for John, starting with a $10,000 investment. In just 1 year, his investment will grow to $11,200. Fast forward to 10 years and the investment will reach $32,645. Give it 10 more years and at the 20-year mark, Smith will push the portfolio value to $124,826. At the 30-year horizon, the investment will be worth $624,365, paying $48,652 in annual dividends, equating to a monthly dividend income of $4,054. The total value added to John's portfolio will be about $614,365, with $362,882 coming from capital appreciation and $251,483 from dividend reinvestment. Now, the fourth best 52-week low stock on our list is Danaher Corp, with the ticker DHR. This company is a leader in life sciences and diagnostics. With a forward yield of 0.47%, this might seem like a lightweight in the dividend arena, but don't be fooled. What it lacks in yield, it more than makes up for in capital appreciation. Boasting an average annual return of 15.3% over the past 10 years. That kind of growth makes you wonder why it's taken a hit. Well, it's mainly because of the slower growth in its life sciences and diagnostics divisions, particularly post-pandemic. The impact of inflation and global macroeconomic uncertainties also weighed on its outlook. Still, overall, its position in life sciences, diagnostics, and environmental solutions ensures long-term growth. Let's look at John's $10,000 portfolio again, this time invested in DHR. After just 1 year, John's portfolio value climbs to $11,577. By the 5th year, the portfolio will double to $20,811, and by the 10th year, it's at $43,389. Fast forward to 20 years, and John's initial investment has the potential to reach a valuation of $189,792. By the 30-year mark, the portfolio value will reach $838,187. The total value added to John's portfolio will be about $828,187, with $792,027, the majority addition, coming from capital appreciation and $36,160 from dividend reinvestment. So you think these returns are impressive? Well, in the end, I'm going to show you a 52-week low stock that can turn your $10,000 into more than $1.4 million. At number 3 on our list, we have Dennison Corp with the ticker AVY, a global leader in labeling and packaging materials. With a forward yield of 1.77% and an average annual return of 15.14%, this stock strikes a beautiful balance between dividend income and share appreciation. If you like steady income paired with the potential for serious portfolio growth, Avery Dennison deserves a spot on your radar. Now, AVY's stock drop was driven by inflation, supply chain disruptions, and weaker than expected Q3 results in its packaging and labeling divisions. Rising raw material costs, logistical challenges, and labor shortages squeezed margins as well, while soft consumer spending led to lower sales in certain product lines. These factors resulted in lower investor expectations. That said, Avery Dennison is set to rebound due to its investments in sustainable materials such as eco-friendly packaging and RFID technology, which align with growing environmental demands. Additionally, strong positions in emerging markets and a recovery in global supply chains will drive increased demand for packaging. As these trends gain momentum, Avery's strategic focus on sustainability and innovation positions it for long-term growth and stock price recovery. Now, if John invests his $10,000 here, after 1 year, his portfolio will climb to $11,691. By year 5, the portfolio value will double to $21,685, and by year 10, it reaches $46,307. The combination of reinvested dividends and share appreciation keeps the momentum going, and at the 20-year mark, John's portfolio has the potential to hit a $204,244 valuation. Give it 10 more years, and at the 30-year mark, the portfolio value will reach around $874,717. The total value added to John's portfolio will be about $864,717, with $832,871 coming from capital appreciation and $31,845 from dividend reinvestment. At number 2, we have Brinks Company with the ticker BCO, a leader in secure transportation and cash management services. Brinks saw its stock fall due to rising operational costs, tighter regulations, and a global decline in cash volume as digital payments have gained traction. Despite these challenges, Brinks' global presence and diversified services, including digital security solutions, position it well for growth. As the cash management sector stabilizes, the stock is expected to recover. It has a forward yield of 1.06% and an average annual return of 15.67%. Now listen, if you're wondering where I get all this data from, let me tell you about our channel's official partner, Seeking Alpha. It's been my go-to tool for winning in investments. It's easy and simple, and I love how I can access under-the-radar investing ideas, earnings call transcripts, and breaking news. Plus, the exclusive data-based stock ratings have been a game changer. Stocks rated strong buy and their alpha picks have beaten the S&P 500 by over 80%. So definitely check them out in the description. They've promised to give a 20% discount on premium membership with a 7-day free trial and a 10% discount on alpha picks to anyone in our community who joins using the link from the video description. Okay, back to Brinks. Let's take a look at John's $10,000 portfolio invested in BCO. In just 1 year, the portfolio value grows to $11,673. By year 10, the portfolio value hits $45,905. Fast forward to year 20, where the portfolio grows to $203,696. This is where Brinks truly starts flexing its compounding muscle thanks to consistent reinvestment and market performance. After 30 years, the $10,000 initial investment has the potential to reach a valuation of $888,552. And now, finally, the best 52-week low stock on our list, Chemed Corp, with the ticker CHE, a company that provides healthcare and hospice care, which can be very lucrative investments. Chemed's stock decline can be attributed to rising healthcare costs, labor shortages, and regulatory scrutiny in its hospice business. Increased inflation and higher operating costs squeezed margins, while staffing shortages impacted service delivery. Additionally, tougher regulations and lower Medicare reimbursements added pressure on its operations. Still, Chemed is well positioned in the growing hospice care market driven by an aging population. Despite short-term challenges, its strong financials and solid market positions suggest long-term growth potential. As labor issues ease and regulatory pressures stabilize, Chemed's stock is expected to recover, making it a solid investment for the future. With an average annual return of 17.83%, this stock is one of the best 52-week low stocks out there. Here's the breakdown of John's $10,000 in CHE. After just 1 year, it'll reach a valuation of $11,819. By the 5-year mark, it'll be valued at $22,999. At the 10-year mark, it'll hit $52,629, with capital appreciation doing most of the heavy lifting. By year 20, John's portfolio will reach a solid $273,423. That's when compounded growth truly fires up. And by the 30-year mark, John's portfolio will hit a valuation of $1,412,067, with the majority of that valuation coming from capital appreciation. Want to know the best Schwab ETF that can deliver more than $22,000 per month? Click the video on the screen to find out.